Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the micro bullish scenario where we're looking for a three-wave corrective structure to the downside for then continuation to the upside, where an important resistance area is the golden box between 38.5k and 39k. Now for an ABC, we're then looking for a flat structure in a 3-3 and then a 5-wave move to the downside, meaning that preferably for a wave C, we're going to see one more low and also take the double bottom over here that price left at 36.1k. For a wave Y, however, this preferably is your low and then a double zigzag structure. Now, if price does move towards the upside and hits this high at 36.8k, it likely invalidates a wave C, as then we have to think about diagonals, but this second move to the downside is longer than the first move to the downside, which means you then have to think about expanding diagonals, and these are very, very rare. So I'm definitely going to keep an eye on the double bottom that we have over here, as well as the invalidation just above. The invalidation of this whole scenario towards the upside and then a bigger ABC or 1, 2, 3 is price taking this low over here at 35.6k. If you then go to the second scenario here, this is a triangle scenario where we're looking for still a wave D and then a wave E to be made. In this scenario, wave A, B and C are made with C being a complex structure and then a WXY double zigzag. So you have WXY double zigzag finished, looking for a move to the upside, where the common target for each wave is between the golden pocket and the 786. Wave B retraced to the 786, wave C to the golden pocket 786 area, which is very nice indeed. And then you're going to be looking for wave D. A couple of rules that are important for a triangle. 4 out of the 5 waves have to be zigzags. Now this move to the downside can be counted as a zigzag on the lower time frames as well, especially seeing the range after, by the way, it increases probabilities that this is a 3-wave structure. If there is a wave that is not a zigzag, however, then it's usually C, D or E, and C and D can then become complex structures and E can become a triangle. Now because C over here is then already a complex structure, for D we then expect a normal zigzag structure in a 5-3-5, right? And also for wave E now, we also expect a simple structure in a 5-3-5 zigzag, because wave C is that one wave which is not a zigzag, as it is a double zigzag in this scenario. Now also we want to see the volume moving to the downside as price is evolving through the triangle, which at the moment is correct. And we also have to look at wave time, and that's a little bit of a thing because this wave A is so incredibly short in time, and just look at the length of wave C, which isn't so nice, lowering probabilities for the triangle as well. And also I first really start to look for triangles after a wave D is in, but I do see it appearing more often here and there, so that's why I like to talk about it. This wave D over here is important only after a wave D is in and we start moving back down. That's when I'm gonna really start thinking about potentially a triangle, because till that moment very often you have 3-wave structures in WXYs or ABCs, and then you get fake outs as well, and of course we want to avoid being on the wrong side of a fake out. So that is why only after wave D I would really start to look for triangles. Now in the bearish scenario, which of course doesn't make too much sense from a time perspective, we're looking for a 1, 2, 3 to the downside or an A, B, C towards the downside. Where for a wave C, common target 35.1k to 34.5k over here, and for a wave 3 you want at least a 1.618 hit at 33.6k. and in this scenario for a wave 2 or B, you're then looking for a W, X and then a Y structure with a zigzag, flat and then a flat over here, for then a move towards the downside. Now what is important here is time, right? Elliott Waves is not only price related, it's also time related. And you can see over here, if you take a fib time from the beginning to the end of wave 1 or A, then the 0.382 is over here. Now usually wave 2 or B is longer than the 0.382, which clearly is the case. But usually a maximum target is about the 3, maybe even 4 fib time if you really want to stretch it, which is here. Not here, right? This wave B or wave 2 is 46 times longer than wave 1 or A. For a very bearish scenario, for then a C or a 3 to the downside, which really lowers the probabilities of a bearish scenario and also therefore really increases the probabilities of price taking at least this high once more before we get bigger retracements to the downside. If you then look at this range over here, then price hit this target box that we were looking for over here. Previously was a blue target box, right, with the key level, which was the point of control of this little range over here. Initially got respected, but then some CVD divergences pushing price to the downside. And now we're at the second level that we mentioned earlier, which is this low over here, holding as support so far. But something that is important is, besides the key level and the low here, we also have this white box, and this white box is a daily gap. So you can see over here you have a little bit of a gap between this high and this low over here, and this gap over here is interesting confluence with that key level, as you can see. So the white box is the gap, the low of the candle over here is the key level. And also, as mentioned earlier, throughout basically this whole move towards the upside, right, gaps are very, very important. Usually the first time they hit, they act as support, and in bullish market structure you want to hit it and then you want to move towards the upside, right? You want to basically hit and go. So in this particular scenario, on the lower time frames, on the 15, you can see we hit it over here, right? Close some candles inside, that's okay, and you want to move away from it. If you come back once more, probabilities are high to fill the gap, and then I'd be looking for the double bottom. As you can see, the double bottom, which is the low of the gap basically as well, are in nice confluence with one another. So then it's nice to take the liquidity, fill the gap, and then move towards the upside for higher prices, as again the A, B, C or 1, 2, 3 scenario really has lower probabilities. Now if we look at the CVD divergences here, then we had continuously bearish CVD divergences during this move to the downside. Small ones here, 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 and here. Also after the bounce on the target box, we had over here price moving up, bearish CVD, bearish, bearish. So these bearish CVDs have now played out. We had some bullish CVD here at the low, which I can show you here. So we had a higher low in price, but look at the cursor line, the horizontal line, and look to the right on yellow. You can see lower high on the CVD, higher low in price, lower low, sorry, on the CVD, which is a bullish CVD divergence, absorption of market shorts going on, pushing price to the upside. And generally, if I would zoom out on this chart here, then you can see higher lows in price, but look at the CVD, it's tanking, right? There's still a lot of absorption going on as well, a lot of selling. And therefore, this also increases probabilities for a move to the upside, because I don't really like to go against CVD divergences. If I am looking for a bigger move towards the downside for either a big wave C or a bigger wave 3 and then an impulse to the downside, I would really like to see bigger bearish CVD divergences with this high and the lower highs created. But at the moment, we do not have any bigger bearish CVD divergences, any absorption of market longs, like bigger absorption of market longs at these highs or with the highs. So at the moment, also from a CVD standpoint, it would make sense to move towards the upside. So if you then look at the probabilities, then on the micro, locally over here, this range so far, probabilities are higher to continue to the upside. However, I do keep an eye on the double bottom over here for a potential wave C, and then an A, 3 wave A, 3 wave B, and then a 1, 2, 3, 4, and then a 5 wave structure to the downside for wave C, and then a move to the upside, where you don't really want price to close all sorts of candles below the gap and below the double bottom here, right? That wouldn't be good. You're then also in a wicky area, so probabilities increase to fill the wick, which is not what we like to see. But yeah, these are currently the probabilities over here in this range. So I hope this video is helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use, in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.